Yeah, so we got a question. We've been doing those. Brendan did a couple of them, the 10x segments that we've really been getting people asking, 10x, 30x. This one was, is Poet Technologies, symbol PTK on the TSX, or Poet on the NASDAQ, does it have 20x potential? So we're going to the middle this time. A lowly 20x gain it's not as great as the 30x, but it's better than that 10x. But Poet Technologies is a designer and developer of optical interposers. The company's optical interposers is an optoelectronic solution that allows for the integration of electronic and photonic devices onto a single chip for usage in high-speed communication for data-intensive applications. So they like to quote AI applications, which everything which can even be tangentially related to AI is these days, but it's for data centers and other high-speed communications. Effectively, the goal of their products are to really scale down existing optical transceiver solutions at this time into a smaller design, allowing for cost savings. And if you don't know what an optical transceiver is, really, if you know what fiber optics are, that's light. It needs to be converted to an electrical signal for computers, and that's what these do. So the stock is currently trading at 318 on the NASDAQ. It's down 15% over the past year, but it has recovered significantly from its low of 80 cents late last year, causing a 6-month increase of 132%. So clearly a volatile stock, and that's really why I think we're getting a lot of interest in. This isn't the first comment I've seen on it, and I've seen a lot of buzz online about Poet Technologies in general. And when you have volatile returns, that's generally what I see anecdotally. So a quick look at the financials. There's frankly not much substance to it at this time. For Q2 2024, the company had no revenue, with low inconsistent revenue in prior quarters, but nothing substantial. And I believe it just relates to engineering services for prior revenue. But even then, it's still nothing material. The company does have a non-consolidated revenue in a joint venture, but at this time, that's completely unprofitable as well. Unsurprisingly, a significant cost is R&D expense at $2.6 million, which does include notable stock compensation about $500,000. SG&A came in at $4.1 million with stock compensation of $1.1 million. So like many tech companies, they're really leaning on that stock compensation. Total operating expenses came in at $6.8 million for the quarter and $11.9 million for the first 6 months of the year. The net loss for the quarter was $8 million or 14 cents a share, or 13.7 million and 27 cents per share for the 6 months. So moving to the company's balance sheet, is comprised of 21.2 million in cash, no debt, but it has leases of 400,000, resulting in a net cash position of 20.8 million. Not bad, right? However, as I said, the company is just not producing any material revenue, so it can't produce cash flow. So you need to really look at where the cash is coming from. For the first 6 months, operating cash flow before working capital, or FFO, was a deficit of 8.1 million. So cash is from raising capital. You can just tell from that line before even looking at anything else. Notably, the company was really effectively out of cash runway at the end of Q1. They then proceeded to conduct private placements and at the market issuance to raise capital. The company at the end of Q2 now has 61.7 million shares outstanding, 11.8 million warrants, all in the money, and 9.5 million stock options as well, also all in the money. Meaning if they all are exercised, the diluted outstanding shares at the end of the quarter is 83 million. I will note only 2.6 million of those options are exercisable at this time, but they are well within the money. So if the price were to even stay at this level, they'd likely be exercised down the line. Through all this, the company had raised 29.5 million in the first 6 months of the year, more than its current existing cash balance. So they would have been negative cash balance if they didn't raise money effectively. They would have been bankrupt at this time. They would have been selling off and liquidating in some sense. If fully diluted, the company they'd actually get cash from their options and warrants, and they'd get another 40 million in that ballpark of additional cash. And that's likely what they are counting on, is just additional exercising of their warrants and options over time. Additionally, after the quarter's end, we have more raising of capital. The company raised another 10 million US through an issuance of 3.3 million in both shares and warrants. So further dilution. The summary of all this is the company needed cash, significantly diluting the company since the start of the year. For comparison, the non-diluted outstanding shares at the end of 2023 was only 41.3 million. So if we went to a fully diluted state, you're looking at literally double the shares over the last 6 months, because they really need to raise that cash. But bringing back to really the initial comment of, is this a 20x stock? To give an idea, that would put the company at a 4 billion market cap. With its current market share, it would be at 4 billion. But if we were to then do the fully diluted market cap, it would be at 5.5 billion. And if you were seeing something 20x, those shares would be 100% exercised on. It would make no sense that they wouldn't. So 5.5 billion if you were to look at something like that. So just the sheer size of the market cap for something like that for a currently zero revenue company is already getting quite absurd. And even if we optimistically valued a company like this for a hardware company, a computer hardware company at 5 times sales, which is already optimistic, a lot of them are only 1 time sales, you'd be looking at needing $1 billion in revenue. And really, I just don't see that happening. That's just too massive a leap. Even if you're looking 5 or 10 years down the line, maybe 10 years, you can maybe make a case for something like that. And that'll be blue sky scenario, best case scenario. You're not doing better than that type of scenario. So I really want to stress on that. By no means do I believe that is going to happen. But even if you were to believe a scenario like this were to happen, where you are expecting a 20x return, because I've seen a few videos, which some of them were actually had received funding from Poet indirectly or directly, where they're stating, oh, it can go way up. I've seen sponsored reports that they're doing their target prices at 2 times the current stock price or 3 times the current stock price. That you need to have these massive runway up in sales over the very near term. And that's just, I don't see the pathway to that. It's a competitive marketplace. They would need to have mass commercial volumes, and that requires the customers to uptake it, which is a hard hurdle to scaling. You need to get big companies in, you need to appeal to them, and that's hard to see from zero revenue to happen that quick. Further, the production actually needs to be profitable at scale because they can't keep issuing shares. They would need money to do it, so it needs to be profitable. That's a massive, massive hurdle, and that's why we like profitable companies, because you don't need to worry about that hurdle. You can't just rely on raising capital forever, and that seems to be what many of these companies do. Not saying Poet will, but that is the trend of these companies, where they just look to raise capital forever and hope to have some sort of revenue someday. But if you were a shareholder today and they keep doing this for another 3, 4, 5 years, you're looking at your ownership of the company being a quarter of what it was, half of what it was, whatever it may be, because they continuously dilute over and over again. And then further, we always get these comments along the lines of that you need to risk to have some sort of high return. And that's just not true. Your job really as an investor is to look for that balance between risk and reward. You're looking at that trade-off. Just because you're taking on a lot of risk doesn't mean you're getting a lot of reward, or potential a lot of reward as well. And I will just further mention is the company is having most of its near-term projects through a joint venture of which it partially owns, but that adds a further risk because it's a Chinese joint venture, and as well a lot of their manufacturing is expected to be that for the near-term products, which furthers the risk as well, and as well it lowers the outstanding return, because obviously the joint venture, the other player in it, gets a portion of that revenue and portion of the resulting equity. So let's say a year from now, they start to have revenue, they start to build a customer base, then it may be worthwhile. As yes, the price may have slightly increased to then, but that does not overcome the risk you have in the short term, in the near term, in the next 6 months, year, 2 years, which even if they do potentially get to that point where they do have revenue, they do have sales, it just is too much risk for what reward you're expected to get, because it already has quite a bit of that priced in at its current time. Like I said, it's went up over 100% in the last 6 months. Are you really expecting that to happen again in another 6 months? You're expecting it to be effectively, like Ryan was saying in his previous segment, we had the best stock in the TSX, and that was about 300% over the past year. That's not going to happen to every single stock, and that's what people who are quoting that 10 to 20x are stating, is you're expecting that 100%, not just this last 6 months, but again and again and again. It's just unreasonable. So it may be worthwhile someday. Poet Technologies may be worthwhile someday, but we'd be waiting for revenue and profitability. And I would not count on its current fundamentals in any way to support its even current stock price, let alone 20x, as they are so far off of being appealing at this time.
Yeah, it's a good summary. And I think just even going through where they'd have to get to be at 20x stock, 5 times sales of $1 billion. I mean, it's just so much that has to go right for this company to get to that stage. And again, we've been harping on this the entire show. Where do you find, and we're talking, the question was on 20x, but where do you find even half that at 10x, which is tremendous growth over like a 5-10 year period? Where do you find that? It starts off with profitable smaller to micro cap companies. Like it's 9 out of 10 basically we're in that category. You're fighting in the bucket that has 1 out of 10. If you're looking at a Kraken, I would rather play in the bucket, the area that has 9 out of 10. And that's where we start to analyze those companies where they've had proof of concept. And proof of concept includes people actually purchasing your product or service. And that's where that is where you can find these companies that have tremendous growth potential over the long term. They're already growing now. Buy them at reasonable prices, watch them grow into the future. Again, I will say that, but the data says that. The data says this is where you should look, and you should listen to the data. And if you keep investing in, the issue too is to find a stock that has 10x potential. You don't just buy one stock. You're going to buy, within a 25 stock portfolio, it may be 10 to 12 that have that potential or have that profile of a business that could potentially be. And you're going to hope to have one or two of those stocks. And even one can change your portfolio. But if 10 or 12 of those all start off as unprofitable, it's not only going to, unlikely to that stock, it's unlikely that any of those stocks are a 10x stock, but it's more likely that those stocks, go down 50% or go down to zero if they're not profitable. If they never can prove out to be profitable, that stock will go to zero. And that's what the flip side is. You're trying to prevent the downside as well in these stocks is far higher if they've never achieved anything close to profitability.
Yeah, and that's really what I mean with that risk return trade off is you want that asymmetric risk, and that's what profitability and underlying fundamentals give you. Is you can still look for those blue sky potential companies, but you also want to mitigate the downside. And companies with no revenue don't really have a bottom floor to their downside. When that happens to a fundamentally strong company, they end up getting bought out. And that's what happens again with like the cash rich companies we cover. They have such strong fundamentals, even if the stock market isn't rewarding them at the time, they end up getting bought out eventually. And you don't see this a lot of the times for these pre-revenue companies or minimal revenue companies or pre-profit companies, because the people who are looking at these companies, they'll just wait till it goes bankrupt, buy the patents for pennies on the dollar of what you want them to.
Yeah, that's a good point.
One thing that I'd like to say is like I've heard, or I can't say that I've really followed this stock, but I've looked at it from time to time because not to put him on blast, but one of my friend's dad is a bag holder in this company going all the way back to, I believe, 2016. And, even the story back then was basically this company is on the cusp of, getting these huge contracts. Again, this is going back like almost a decade ago. And what have we seen? Realistically, nothing other than, dilution, a rollback, fundamentals that just haven't improved in any which way. And hopefully he, no longer holds the company because really realistically looking back, from 2016, he basically be, flat or slightly down, when he could have been investing in great businesses. But like Brett was saying, just the dilution, they're just constantly diluting. They've got no cash flow. Not only have they been doing, private placements, they've also got their own at the market facility, which allows them to, kind of regularly issue shares as well. In the last quarter, they did a couple private placements. They were using this at the market facility. Subsequent to the end of the last quarter, they're continuing to do, private placements. So it's not a company that we would invest in, obviously. And, not one that we would say has 20x potential.
Yeah. Part of this, I was looking at some of their old YouTube videos, and the story which they were really putting out seemed to really be the same, even though I was looking at videos from 3 to 5 years ago up to even only a few months ago. It's the same story all along. But when is it happening? And it hasn't happened yet. That's and I'm not leaving my money in dead money for 10 years to hope something happens.
Yeah. And this whole story was, initially put on my radar and pitched to me as a hot stock tip while we were up at the lake on the boat the one summer having some beers. Not the place that you should be getting your stock tips from. Anyways.
No, avoid that. Okay.
Yeah.
After a few beers, that's always the best time to get the best stock tips. Yeah.
Yeah.